Well, now let's see the influence of earnings reports, dividends, and splits on the stock price. First, let's see earnings reports. Every 3 months, all public companies must report the earnings that have been produced in the last quarter. Usually, with this report, the companies also present a projection of future business operations. It is very important to be aware of the days when companies report their earnings, because generally on this day, there is a substantial movement of the stock. If the reported earnings are higher than expected by most financial analysts, the stock price tends to rise. In contrast, if the reported earnings are lower than expected by analysts, the stock price tends to fall. This can be seen in the following example. The blue circle indicates the day the company reported earnings. Clearly, the next day there was a large increase in the stock price, and this was due to the fact that the earnings reported were higher than expected. This is what caused a large increase in the stock price, and this movement was accompanied by a high trading volume. Now, let's see the influence of dividends. Some companies pay out to their shareholders a percentage of the stock's profits. This payment is called dividends. In general, before the company pays out dividends, the stock tends to rise because in order to have the right to collect the dividends, we must have purchased the stock a few days before payment. Therefore, by increasing the demand of the stock, the price tends to rise. In contrast, a few days after the payment of dividends, the stock price tends to fall. This can be seen in the following example. The blue circle indicates the day the company paid out dividends. Notice that on the days before the payment of dividends, there was an increase in the stock price, and after the payment, there was a decline in the stock price. Now let's see the influence of splits. A split consists of dividing the existing shares of a company into multiple shares. The rate at which the shares are divided is expressed as X for 1, where X is the number of shares that the investor will finally hold for each share he or she already owns. For example, in a 2-for-1 split, each stockholder will receive 1 additional share for each share he or she already owns. After the split, the stock price decreases by the same proportion of the division, so the total dollar value of the shares remains the same. Therefore, if we own 100 shares of a company trading at $50, that is, we have $5,000 invested, and the company decides to perform a 2-for-1 split, when the split is performed, the stock price will be $25, but we will hold 200 shares. Of course, we will still have $5,000 invested. That is, a 2-for-1 split means we get twice as many shares, but at half the price. A company performs a split when its stock shares reach a very high value. So by decreasing the price of the shares with the split, the stock becomes more attractive to investors. In general, when a company performs a split, the stock price tends to rise as it becomes accessible to a greater number of investors. It is important to mention that there is another type of split that is called reverse split. It consists of a reduction of the existing shares of a company that increases the stock price. For example, if we own 3,000 shares trading at $1, that is, we have $3,000 invested, and a 1-for-3 reverse split is performed, we will hold 1,000 shares at $3 each. That is, we will still have $3,000 invested. That is, in a reverse split, the amount of shares is reduced, but the stock price increases by the same proportion. This can be seen in the following example. The blue circle indicates the day the company performed a split. In this case, it was a 2-for-1 split, that is, after the split, each investor got twice as many shares. Notice that on those days there was an increase in the trading volume, and after the split, in effect, there was an increase in the stock price. Here we ended with the chapter of technical analysis. In the next chapter, number 4, we will talk about fundamental analysis, in order to have criteria and tools to choose which stocks to invest in over the long term.